Moving institutional wealth across the globe today relies on a fossilized relic of a correspondent banking system. Trillions of dollars sit in a holding pattern every Friday afternoon, waiting for bankers to finish their weekend golf games and actually open the vault doors on Monday morning.
Bypassing that entire correspondent banking delay requires digitizing the commercial bank money itself. Kinexy's JPMorgan's blockchain division rolled out JPMD in November 2025 to put US dollar deposits directly onto public blockchains.
Waiting for a cross-border wire transfer feels like sending a telegram in an era of instant messaging. You hand over a message, hope the operator taps it out correctly, and wait days for a response while the rest of the world is texting in real time. We accept these massive delays simply because the foundational infrastructure was built decades ago.
Deploying JPMD on base drops regulated fiat directly into a decentralized environment that ignores traditional banking hours. Base operates as an Ethereum Layer 2 network heavily developed by Coinbase.
Using the main Ethereum network for this would be a total disaster. The network gets congested the second thousands of people try to send money at the exact same time.
Transaction fees skyrocket. Moving $10 could cost $50 in gas fees just to get the transaction approved by the thousands of computers running the network.
Base functions like a high-speed express lane built directly over that main Ethereum highway.
Bundling thousands of transfers together, calculating the cryptographic proof off-chain, and writing a single final receipt back to the Ethereum mainnet.
Driving those transaction costs down to a fraction of a cent. Ethereum virtual machine-compatible wallets are executing sub-second settlements 24 hours a day. They plug their existing infrastructure straight into the Layer 2 express lane.
Crypto market maker BTC2 and Mastercard are running the first trial transactions on this network right now. High-frequency crypto arbitrage requires immediate liquidity to exploit tiny price differences across global markets.
If they spot a $50 price gap between an exchange in the US and an exchange in Asia, they need the cash on the Asian exchange right that second. Wiring funds from a New York bank account takes 3 days to clear. By the time the cash arrives,
The opportunity vanished while the money was stuck in a banking queue. Integrating JPM Coin gives a trading firm real-time, on-chain settlement combined with the assurance of a regulated USD deposit.
B2C2 proves this works for high-speed crypto arbitrage. Applying this technology to traditional corporate payments completely shifts the scale. Mastercard is building an interoperable network to route commercial payments securely across competing blockchains.
Laying the groundwork for a future where corporate payments flow across blockchains just as easily as consumer credit card swipes flow across the proprietary network today. A corporation paying a supplier in Europe bypasses the correspondent system entirely.
The transaction metrics Kinexy is pushing right now claim $3 billion a day in volume across their private network. Stop right there. JP Morgan's total daily payments volume sits at $10 trillion. $3 billion is a rounding error. It barely registers on their massive balance sheet. You have to justify why this base integration matters when the actual volume is statistically insignificant.
Moving $10 trillion daily feels like buying every single house in a mid-sized city before you even finish your morning coffee. Kinexys handles a microscopic fraction of that flow today because they are buying a single tool shed to test the plumbing before attempting to buy the entire city.
Graduating from a highly controlled private sandbox into the chaotic public environment of Ethereum's Layer 2 ecosystem.
Bringing institutional money onto a public Layer 2 tests the capacity of the broader crypto ecosystem to handle commercial bank deposits. They trust the cryptographic security of Base can withstand the constant attacks that define public blockchains.
Trapped capital costs large institutions millions. When funds take 3 days to clear, you cannot deploy that capital for trading. JPMD unlocks that liquidity instantly.
JPMD acts as a direct digital representation of commercial bank money engineered strictly for institutional clients.
JPMD is crashing a $262 billion market entirely dominated by stablecoins like Tether and USDC. Minting a traditional stablecoin introduces severe friction. You have to wire fiat currency out of your bank account to a crypto exchange.
Trusting a third-party issuer to hold the cash reserves safely.
Minting JPMD just requires a US JPMorgan Chase bank account. The money never actually leaves the bank's ecosystem.
Commercial banks refuse to let liquidity drain away to third-party tech companies. A deposit token ensures the money remains inside the traditional banking system. The token moves across the blockchain, transferring the claim on the underlying deposit from one client to another.
The massive financial differentiator targets the core revenue model of the crypto industry. Stablecoin issuers take your cash, buy short-term US Treasury bills, collect the interest from the government, and keep every single penny as profit.
JPMD is engineered to eventually pay interest directly to the token holders.
Using a traditional stablecoin is like giving your life savings to a friend who keeps all the bank interest for themselves.
Monopolizing that yield forces institutions to leave billions of dollars on the table. Cryptocurrency trading firms rely on stablecoins to collateralize positions and move massive amounts of money across competing exchanges.
Earning interest on those overnight balances provides a massive competitive advantage. Institutions hold their assets in a yield-bearing, bank-backed token while using that exact same token to collateralize high-frequency trades.
The U.S. Senate voting on the Genius Act establishes strict rules for stablecoin issuers. The European Union is actively enforcing their markets in crypto assets regulation.
Lawmakers across the globe are aggressively closing the regulatory loopholes. They demand this activity move inside the regulated banking sector.
Private tech startups spent the last decade issuing billions in digital tokens with minimal oversight. Commercial banks already operate under the strictest federal oversight on the planet, holding the immense capital reserves that stablecoin issuers are scrambling to build.
The demand for yield and strict compliance leads directly to the massive January 2026 announcement. JPMorgan and Digital Asset are bringing JPMD natively to the Canton Network.
Canton operates as a public, permissionless blockchain governed by the Canton Foundation. It synchronizes multiple asset classes on a shared infrastructure.
Hold on. You are telling me Canton is public,
Built from the ground up to give institutional finance massive scalability.
but also totally private for these megabanks. If it is a public blockchain, anyone can view the ledger. Banks refuse to expose their trading strategies to competitors. How does Canton satisfy that intense paranoia while remaining public?
Canton isolates transaction data cryptographically at the node level. Sending a transaction on Canton operates exactly like sending a locked safe through a public mailroom.
Everyone in the mailroom can see the safe moving from point A to point B.
Only the specific banks involved in the transaction hold the mathematical key to open the safe. They are the only nodes capable of decrypting the payload and viewing the sensitive financial details.
The public sees the movement, but they have absolutely no idea what is inside.
Validating the mathematical proof of a trade happens without ever broadcasting the actual monetary amounts to unrelated nodes. The phased 2026 integration approach focuses heavily on establishing technical frameworks for near-instant issuance and redemption of JPMD directly on Canton.
Kinexys is also testing integrations like blockchain deposit accounts. The roadmap stretches far beyond the US dollar.
Filing a trademark for the ticker JPME signals a direct intent to launch a euro-denominated deposit token. They are building the infrastructure to tokenize the major fiat currencies of the global economy.
You take tokenized US dollars, tokenized euros, and tokenized treasury bills, and you put them all in the exact same interoperable network. This points toward an incredibly disruptive final destination.
The deposit token integrates directly with smart contracts on public blockchain networks. A smart contract acts as code written onto the blockchain that executes automatically when specific conditions are met.
Traditional fiat money lacks any operational capability. A paper $100 bill cannot do anything on its own.
Coding instructions directly into the JPMD token programs the money itself. The blockchain monitors external shipping data continuously, triggering the smart contract the moment the cargo arrives at the port.
The token moves to the supplier's wallet instantly. Invoices become completely unnecessary. The payment executes without any human authorization whatsoever.
Verifying compliance instantly without requiring a human officer to review the paperwork.
The sheer speed of capital changes everything. Institutional money is becoming programmable. Corporate bank accounts are moving toward operating autonomously, executing complex trades, and moving massive capital across the globe without any human intervention, leaving traditional banks to slowly realize their correspondent networks are entirely obsolete. Catch you next time.